My name is Blessing Johnson Wankwe. You are welcome to bookkeeping class on the theme Introduction to Bookkeeping and Accounting, and the topic is Cash Book Part 1. At the end of this lesson, you are expected to know what a cash book is and why it is called a cash book. You are also expected to know the types of cash books and the uses of the various cash books. Now, it is common for every one of us at one point in time or the other to make purchases at the supermarket. When you buy stuffs at the supermarket, you make payments across the counter. Your payment can either be direct cash payment, that is counting notes and paying across the counter, or you make payments through your debit card. You can also make payments through the use of credit card or through instant transfer using your mobile devices. Payments can also be made through checkbook. That's to say, after having bought the items, you write the amount on a check leaf and pay to the seller. But that's acceptable only at trusted places. Places where the seller knows you and can trust your checkbook. When payment is made through any of these means, we say a cash transaction has taken place. What then is a cash book? You see, from the illustration just mentioned, when you make payment for items bought, someone at the seller's office or from the supermarket or superstore records what you have bought and what you have paid. In a document where payment made is recorded is called a cash book. A cash book, therefore, is a book that records cash transactions only, which is to say, when you buy items with the intent of paying at a later date, it is not recorded in a cash book. If you buy items and pay partly for the items bought, only the portion or amount that the seller has received from you will be recorded in the cash book. The cash book is usually maintained by a bookkeeper, a cashier, or a cash officer. There are three types of cash books. Cash book maintained by the cashier may either be a single column cash book, a double column cash book, or a 3-column cash book, which means the cash book is made up of columns. If the types can be single, double, or 3 columns, it means there are columns in the cash book. But what column are we actually referring to when we classify cash books by columns? We are looking at the amount side of the cash book. The amount side of the cash book for a single column cash book is single. However, if the cash book is a double column cash book, it means there will be 2 columns in the amount side of the cash book. And if the cash book is a 3-column cash book, it means there will be 3 columns in the amount side of the cash book. A single column cash book records only cash receipts and payments made across the counter. In our illustrations given, when you buy things from the supermarket or from the superstore, you pay cash. And as you pay cash across the counter, it is recorded in the book called the cash book. So that book that records cash made across the counter is called the cash book. And if that book records only cash that is made across the counter, it is called a single column cash book. It has a single column for amount on both the debit and the credit side. By this we mean, if this is the cash book, there is the left-hand side called the debit side, and there is the right-hand side called the credit side. The debit side is usually connoted by D arrow, and the credit side connoted by C arrow. This is the way the cash book looks. Now, the cash book has columns, as we earlier mentioned. And the first column in the cash book is called the date column. The next column is the particulars column. The next column is the amount. As it is on the debit side, so it is on the credit side. The date, column, the particulars column, and the amount column. The date column records the date the transaction took place. The particulars column records the particulars, the summary of the activity that is involved. The amount column records the value received or given out. The debit side records the value received. The credit side records the value given out. Now for a single column cash book, we say it has a single column for amount on both the debit and credit side, and this is the amount. If the cash book has a single column on this side, as it is shown here, it is called a single column cash book. On both the debit and the credit side, it has a single column for amount. Hence, it is called a single column cash book. We'll look at a few transactions and how they are treated in the single column cash book. Firstly, on March 1, the business had cash in hand, 50,000 naira. On March 2, the business purchased goods for cash, 5,000 naira. On March 3, the business bought office furniture for cash, 6,000 naira. On March 20th, the business paid salaries for cash, 10,000 naira. And on March 28th, the business paid electricity for cash, 2,500 naira. And we shall use the cash book to show how these transactions are recorded. To do this, we'll enter the name of the business first. Johnson Stores, cash book, and withdraw the line. This format is called the T accounting system. On the debit side is the left and the credit side is on the right. We did mention that the cash book has columns. The first column is the date column. The next is the particulars. We have the folio and the amount. And we said as it is on the debit side, so should it be at the credit side. And so we will have date, particulars, folio, and amount. Now we come to the transactions we want to post. We said on the first day of March, the business had a cash of 50,000 naira. So because the business had a cash of 50,000 naira, we'll come to the debit side to post it. However, let's remember that the principle of double entry is our guiding rule in posting transactions. What does the principle say? The principle says whenever cash is received, we'll post it on the debit side, and whenever cash is given out, we'll record it at the credit side. In the question given, on first day of March, there was cash in hand, 50,000 naira. As mentioned, we are guided by the double entry principle, which says whenever the business receives money, it should be recorded at the debit side, and whenever the business gives money, it should be recorded at the credit side. By this, if we go back to the transaction on March 1, the business had cash in hand worth 50,000 naira. So we come under the date column. The first thing to do is to come to the date column and enter March 1. The business had a balance of 50,000 naira. So we say balance brought forward. And the amount is 50,000. You may be wondering why I did nothing about folio. This column for folio records the reference number of a transaction that has taken place. But as we see, in March 1, it wasn't a transaction, but we brought the cash balance that is in the office. So that cash balance, there is no folio for it. So our amount there on the debit side is 50,000. And we entered that amount, 50,000, on the debit side because cash was not given out. it was cash available. Remember, we are guided by the double entry principle. Next transaction. On March 2, the business purchased goods for cash worth 5,000 naira. It is necessary to mention here that whenever the business buys goods with the intention of selling them, it is called purchases. Now, the double entry principle is applied again. 5,000 naira for goods purchased. Remember, value or money is departing the coffers of the business. The business is giving out money, and so it will be on the credit side of the cash book. The first thing we do here is to record the date. And what is the date? March 2. The next is to come to the particular side. What happened? Purchases took place. So we say purchases. The business would have recorded this transaction in their purchase voucher and would have called it PV1. So we say PV1. Purchase voucher 1 is the reference number of this transaction that took place. And the amount is 5,000. You want to know the difference between the first transaction and the second. The first transaction here, the business had cash balance and money did not leave the office. The second transaction, the business gave out money. That is why it is recorded on the credit side. And 5,000 is recorded under amount column because amount shows the place where you record value. Monetary value. And so we record the 5,000 under the amount column. We'll see the third transaction, what happened. On March 3, the business bought office furniture for cash worth 6,000 naira. So what do? Remember, for each transaction, we apply the double entry principle, which says whenever the business receives money, you record it at the debit side. Whenever the business gives out money, you record it at the credit side. Therefore, considering this transaction on March 3, where the business paid out money for office furniture, you see that it will be recorded on the credit side. And what is the first thing you do whenever you want to record? Come to the date column and enter the date the transaction took place. March 3. What happened? They bought office furniture. So we enter office furniture here. Office furniture. And the business would have recorded this in their payment voucher and would have called it the second payment that took place in the payment voucher. So we say PV2. And what is the value? Under amount column, we enter the value 6,000. As you can see, the two transactions on the credit side showed that payment was made from the business available cash. The amount on the debit side shows that the business had cash of this value. So it's from this value, from this amount that the business has, that these payments have been made. We'll look at other events that are taking place. On March 20th, the business paid salaries for 10,000. We come again. Remember the double entry principle. Each time we want to post a transaction, as I mentioned, we'll have to recall the double entry principle. It's our guide. And it says that whenever the business receives cash, you record it at the debit side. And whenever the business pays cash, you record it at the credit side. And now the business paid salary on March 20th. What do? The first thing we do is to come to the date column and enter the date, March 20th. Having entered the date, what event took place? They paid salaries. So we enter salaries. And the business would have recorded this transaction in their payment voucher. Payment voucher. And the number of that payment voucher may be PV3. PV means payment voucher number 3. And the amount here, we pick the amount as 10,000. We once again see that from this cash book, the business had 50,000 naira cash and had paid out some values. 5,000 was paid out, 6,000 was paid out, and 10,000 was paid out. As you can see, all payments are recorded at the same side, the credit side. We'll look at the next transaction. The business paid electricity bill for cash, 2,500. Recall once again that the double entry principle says whenever the business receives cash, you record it at the debit side. And whenever the business pays cash, you record it at the credit side. Now, using the double entry principle as our guide, we say on which date? On the 28th of March, we'll come to the date column. March 28th. What did the business do? They paid electricity bill, electricity. It would have been recorded in their book, in their payment voucher book, and that payment voucher book may be PV form, and the amount is 2,500. So as you can see, we have recorded the transactions successfully. Firstly, cash balance that was available was recorded at the debit side, and all other payments that took place were recorded at the credit side. If the business had made sales and had received value, it would have been recorded at the debit side. What next do we do? This book, transactions have been recorded, but do we leave it like this? No. The cash book is not complete. Even though we have recorded all transactions given in the question problem, the cash book is not complete. The next you will do is to balance your cash book. How do you balance? You go to a rough sheet first and sum up the values on the credit side, record it at the side, and sum up the values on the debit side, record it at the side, and compare the two values, the values on the debit side and the values on the credit side. You compare the two. When you compare them, you look at which is greater and find the difference between the two. This is how it is done. The values on your credit side. We have 5,000, we have 6,000, we have 10,000, we have 2,500. The sum of the values on your credit side will give us 11,000 plus 10,000 is 21,000 plus 2,500 will be 23,500. The values on your debit side is just a 50,000 naira. So as you can see, the value on the debit side is greater than the value on the credit side. And so we find the difference between the value on the debit side and the value on the credit side, which is 50,000 minus 23,500. This will give us 26,500. The difference will be 26,500. Now, why are we doing this? At the end of the day or at the end of the month, your account must balance. We're talking about balancing your account. We want to make the values on the debit side equal to the values on the credit side. And that is why we have to look for the difference. Remember, we are doing this on a separate worksheet. It's a rough work we have just done. Now we come to our cash book. The summation of these values is 23,500. The summation of this value is 50,000. How do we equal the two values? We say the difference between this and this is 26,500. So that if we add this 26,500 to this side will be equal to 50,000. If we add 26,500 to this side, to the credit side will be equal to 50,000. And this 26,500 is the difference between the debit side and the credit side. It's the difference between the side with the larger value and the side with the least value. So, The difference is 26,500. And it brings this side, the debit side, is 50,000. Whenever you balance your account or you want to balance your account, firstly, sum up the values of the two sides separately as mentioned. And then you look for their difference. The difference between the two sides, you add it to the side with the least value. That difference is called a balance. It's a balance. And this balance is called balance carried down. This 26,500 is called balance carried down. You are carrying it down. Is some part of this money, of this larger value, we are bringing down. So we call it balance carried down. But in accounting and bookkeeping, I want us to note that whatever is a balance carried down on this side will become a balance brought down on the opposite side. Whatever is a balance carried down on one side will be a balance brought down on the opposite side. And like I mentioned earlier, the balance carried down is usually the difference between the side with the higher values and the side with the lower values. When we find the difference, we add it to the side with the lower values to bring the total of the side with the lower value to be equal to the side with the higher value. That is how to balance the account. In summary, what we have so looked at simply explains the single column cash book. And we did say a cash book is a book that records cash transactions only, transactions that involves cash payments only. And we also did say that this cash book is of three kinds. We also did say that this cash book is of three kinds. There is a single column, there is a double column, and there is a three column. We also did say that the single column cash book records cash receipts and cash payments made across the counter. And we say in recording cash transactions, the principle of double entry is strictly applied. Now we want to look at some test questions to examine your assimilation of what we have so discussed. Which of these statements is not true about a single column cash book? A. Credit sales are recorded in a single column cash book. B. When a customer makes a part payment for goods bought, the amount received from him is recorded while the amount outstanding is not recorded. C. Payment through ATM transfer is not recorded. D. Payment for transport is recorded at the credit side. So from what we have seen, A is not true. Next, which of these statements is true about the single column cash book? A. The single column cash book records only cash receipts and payments made across the counter. B. Cash received for goods sold is recorded at the credit side. C. Payment for electricity bill is recorded at the debit side. D. Check received is recorded at the debit side. The single column cash book records only cash receipts and payments across the counter. That is the definition of the single column cash book, and is as true as stated. B. Cash received for goods sold is recorded at the credit side. That is wrong. That contravenes the double entry rule. The double entry principle says whenever cash is received, record it at the debit side, and whenever cash is paid out, record it at the credit side. Therefore, this statement is not true. C. Payment for electricity bill is recorded at the debit side. That is also not true because it contravenes the double entry principle. Payment for electricity bill, all payments are recorded at the credit side. So, electricity bill cannot be recorded at the debit side. D. Check received is recorded at the debit side. That is wrong. The single column cash book records only cash paid across the counter, and check is not cash. Check can only be converted to cash in the bank, and so it cannot be recorded in the single column cash book. Therefore, the answer to this question problem here is A. So A is the answer. On this note, we have come to the end of the part 1 of our lesson on cash book. Thank you. Thank you. Thank you. Thank you. Thank you. Thank you.